Payday loans are short-term cash loans based on the borrower's personal check held for future deposit or on electronic access to the borrower's bank account. Borrowers write a personal check for the amount borrowed plus the finance charge and receive cash. In some cases, borrowers sign over electronic access to their bank accounts to receive and repay payday loans. Lenders hold the checks until the borrower's next payday, when loans and the finance charge must be paid in one lump sum. To pay a loan, borrowers can redeem the check by paying the loan with cash, allow the check to be deposited at the bank, or just pay the finance charge to roll the loan over for another pay period. Some payday lenders also offer longer-term payday installment loans and request authorization to electronically withdraw multiple payments from the borrower's bank account, typically due on each pay date. Payday loans range in size from $100 to $1,000, depending on state legal maximums. The average loan term is about 2 weeks. Loans typically cost 400% annual interest, APR, or more. The finance charge ranges from $15 to $30 to borrow $100. For 2-week loans, these finance charges result in interest rates from 390 to 780% APR. Shorter-term loans have even higher APRs. Rates are higher in states that do not cap the maximum cost. Requirements to get a payday loan. All a consumer needs to get a payday loan is an open bank account in relatively good standing, a steady source of income, and identification. Lenders do not conduct a full credit check or ask questions to determine if a borrower can afford to repay the loan. Since loans are made based on the lender's ability to collect, not the borrower's ability to repay, while meeting other financial obligations, payday loans create a debt trap. CFPB found that 80% of payday borrowers tracked over 10 months rolled over or reborrowed loans within 30 days. Borrowers default on 1 in 5 payday loans. Online borrowers fare worse. CFPB found that more than half of all online payday installment loan sequences default. Payday lenders. Payday loans are made by payday loan stores or at stores that sell other financial services, such as check cashing, title loans, rent-to-own, and pawn, depending on state licensing requirements. Loans are made via websites and mobile devices. CFPB found 15,766 payday loan stores operating in 2015. Legal status for payday lending. High-cost payday lending is authorized by state laws or regulations in 32 states. 15 states and the District of Columbia protect their borrowers from high-cost payday lending with reasonable small loan rate caps or other prohibitions. 3 states set lower rate caps or longer terms for somewhat less expensive loans. Online payday lenders are generally subject to the state licensing laws and rate caps of the state where the borrower receives the loan. For more information, see legal status of payday loans by state. Protections for service members and dependents. Payday loans are not permitted for active duty service members and their dependents. Federal protections under the Military Lending Act, MLA, for service members and their families took effect October 1, 2007 and were expanded October 3, 2016. Department of Defense rules apply to loans subject to the Federal Truth in Lending Act, including payday and title loans. Lenders are prohibited from charging more than 36% annual interest, including fees, taking a check, debit authorization, or car title to secure loans, and using mandatory arbitration clauses in contracts for covered loans. The Consumer Financial Protection Bureau enforces the MLA rules. What are the risks of payday loans? One of the biggest risks is getting trapped in a cycle of debt, for example, borrowing money because you're short on funds, then being short on funds again because you're paying back a loan plus a lot of interest. Payday loans can hit you with fees for not repaying them on time or in full. These fees are capped by the Financial Conduct Authority at $15 plus interest on the amount you borrowed. But considering how high rates are on payday loans, often around 1,500% APR, being unable to repay it can get very expensive. Remember, interest is calculated as a percentage of the amount you borrow, and it's usually charged daily for payday loans. So the larger your loan and the longer you have it for, the more interest you'll pay. When is a payday loan a bad idea? Getting a payday loan should never be taken lightly. If you're already in debt or you're not 100% sure you can afford to pay it back, then it's probably a bad idea. Because of the high rates and risk involved in getting a payday loan, it's generally not worth it for something that can be delayed or to buy something you don't really need. If this is the case, it may be better to save up, borrow from friends or family, or look for a cheaper form of credit.